AI certainly remains a theme, but it feels like less of a driver of performance as investors really start to focus not just on the AI opportunity, but how will those AI products and initiatives ultimately change the P&L of those companies. Overall, investors continue to reward high quality, durable, and profitable growth stories in this much more volatile macroeconomic environment.
Hey, everybody. You're listening to What's the Deal, our investment banking series here on JP Morgan's Making Sense podcast. I'm your host, John Zimmerman, the vice president on our private capital markets team. Today, we're recapping the recent market activity in equity capital markets with Nadine Yang, an executive director in our technology equity capital markets group based in New York. Nadine, welcome to the podcast. Great to have you.
Great to be here.
So Nadine, before we dive into the market discussion, I think it would be helpful if you could introduce yourself to the listeners, share a little bit more about your career here at JP Morgan.
Definitely. I joined JP Morgan in 2015 in strategy after a 4-year stint in consulting. And since then, I've had a diverse set of roles across equity capital markets, private capital markets, and financial sponsors in Hong Kong and New York. It's been a great journey so far.
Great. Let's jump into the conversation. We've had a dramatic start of August in global equity markets. Could you provide a quick recap of the market activity over the past few weeks?
Yeah, so it's been a bumpy ride, and I think it's likely going to be a bumpy ride for a bit longer. The first full week of August started off with equities logging their worst daily decline since 2022 and volatility spiking to 65, the highest level since COVID roiled markets in 2020. This was largely driven by disappointing macro data, concerns of weakening growth, and repricing of recession probabilities, as well as the global unwinding of the yen carry trade. Our colleague from our Asset and Wealth Management division, as well as frequent guest on the podcast, Michael Semblis, has shared that the conviction in the AI-driven rally was so uniformly held that by mid-July, short interest on the S&P and NASDAQ practically disappeared, really contributing to the lack of volatility in the market to date. We also heard from mutual funds that they had been positioned defensively heading into earnings, given what they perceived to be overheating in the broader markets.
Gotcha. Interesting. And then when you think about the turbulence in August, how did you see or how would you characterize the market response following that initial decline?
So when we first saw a lot of the volatility, we felt like a lot of this was very much technically driven, underpinned by some fundamentals. And I think we ultimately ended up being right. We saw a quick recovery in the markets. And after this short-term volatility logging the best 2-day run of the year on August 8th and 9th, the market continued to accelerate on the back of strong macro data, which included a good inflation print, resilient growth numbers, favorable July end earnings, as well as dovish Fed rhetoric. And the market ended up closing the week, ending July 16th, with the strongest 1-week performance that we've seen since November 2023. So, John, now that we've talked a little bit about what was happening in the broader equity markets, what are you seeing on the private side?
Yeah, thanks, Nadine. I think the private capital markets remain active across all fronts. I think as a private capital group here at JPM, we've raised a little over $15 billion of capital year to date on behalf of our clients. We're busy with our traditional growth capital and pre-IPO mandates for our private clients and have active dialogue around pipes for acquisition and catalyst-driven financing for our public clients. Sponsor secondary opportunities, particularly within mid to late stage, more mature private companies, predominantly in software, remain very active and interesting to us. And then lastly, our special situations business, what I'll call capital solutions or hybrid capital opportunities, remain very active. We're working with a number of issuers, both public and private, on structured capital solutions to provide non or less dilutive equity and credit-oriented capital to support growth, M&A, broader capital structure refinancings. Overall, I'd say we're feeling pretty optimistic. We really like the quality of opportunities we're actively working on right now and see our pipeline for the second half of the year. I mean, at this point, really Q3 and Q4 post Labor Day as really exciting. So I'd say we're in prep mode now, but looking forward to a fairly active rest of 2024.
That's great to hear. Thanks for that, John.
Shifting our focus to the technology sector, what trends are you observing there?
Yeah, so the major theme since 2023 has really been the outperformance of large cap stocks. Now, that outperformance continues to be highly concentrated in select stocks. And I'll give you one data point, which is that only 20% of the companies in the S&P are actually outperforming the S&P today. That's the lowest level it's been since the 1990s. And that's compared to what it has been historically, which is roughly around 40%. The Mag 7 in particular continues to outperform. And just to note, NVIDIA driving the largest performance gains year to date. It's up over 150%, followed shortly by Meta, which is up over 50%.
NVIDIA is interesting in that we see the look through from some of the publicly traded AI stocks is definitely being reflected in the private capital markets, both from an interest level, I think from a valuation perspective as well. I think you're also seeing some private AI businesses. You've got a lot of private AI businesses that feel like they're in a bit of an AI crosswind. Maybe talk a little bit about valuation. How should we think about current valuations for AI-related stocks? I mean, some of the volatility is going to play into it of late, but talk to us more about what you're seeing on the valuation side of things.
Yeah, and maybe I'll make one comment more broadly speaking, which is that at the end of the day, the equity markets, particularly technology equity markets, growth is probably the number one focus for investors and ultimately for valuations. Valuations for AI continue to reach record levels. And just to give you a sense, the average price to book ratio for semis related stocks over the past decade has really been between 2 and 4 times historically, but has reached 12 times today. And that's because of the level of visibility in terms of growth that a lot of the investors have for each of these businesses. Across tech more broadly, we are still below record valuation levels from 2021, with the exception of some of those best-in-class growth stories. And the number of tech companies trading above a 15 times revenue multiple is 90% lower than where it was in 2021. It was 63 companies in 2021 versus just 4 today. I think at the end of the day, when we look through what's going on in the public markets back to the private markets, it's really about that visibility into growth and what are the macroeconomic factors and business specific factors that are going to drive investors to be able to underwrite those growth stories.
Totally. I think from the private capital market lens, we are seeing that bid ask on valuation tighten up a bit, where it felt like maybe even late last year and a little bit into early this year, we were still struggling a little bit to marry investor expectations with issuer expectations, and then thinking through, okay, are there ways to introduce a degree of structure to meet in the middle? But it does feel like a rather stable, dare I say, public equity environment, which obviously hasn't been the case for the past couple of months, is lending to that bid ask tightening up a little bit. Maybe switching gears here and just thinking a little bit about earnings. So we just came out of earnings season. Any themes you picked up on your side this quarter, how they compare to previous quarters, maybe even the look through of what that's going to potentially mean for deal activity in Q4, and I guess for the remainder of Q3. But what was your take on earnings? And then what do you think the look through is for the rest of the year?
Yeah, so overall, earnings were stronger than we expected, and EPS growth actually came in better than we originally estimated at roughly 8% year over year. The other key takeaway that we saw was a broadening in earnings delivery, with the S&P 500, excluding the Mag 7, delivering the first positive EPS growth that we've seen in over 4 quarters. We're also seeing, just from a number of data points throughout the earnings season, indicating a cautiously stabilizing spend environment, particularly for software, which has really been the main driver behind lower than expected growth expectations for a lot of software and technology services companies. So overall, really positive and exactly what we were hoping to see as we look forward towards the change in the Fed interest rate curve.
So overall, sounds pretty positive. Any areas where we saw general underperformance?
Yeah, well, broadly, we see earnings this quarter as being robust. Some metrics have underperformed, including the percentage of companies beating sales estimates. That's been lower than what we have seen historically. Within tech specifically, certain subsectors have definitely underperformed, specifically calling out tech services, which had the lowest percentage of companies beating earnings at roughly 41%. And that's largely driven by some of the themes that I called out earlier, which is really around the visibility to IT spend against both an uncertain macroeconomic environment as well as enterprises pressing pause on new spend as they evaluate the AI landscape.
Got it. And then thinking through how we opened this section of the pod and thinking about the look through from an investor's perspective, working through earnings and then also transitioning to guidance, sitting in the investor's seat now, what have you heard from investors? How do you think investors are reacting to the latest slate? And what do you think that means for their general participation for the rest of the year?
Investors have mostly been focused on the magnitude and sustainability of performance as a read through to future quarters. For companies that have missed or offered more conservative guidance, investors have been focused primarily on the drivers of that underperformance and whether the challenged macro environment will continue to put pressure on financials. And overall, we've seen the bar get that much higher for companies in terms of what they're actually showcasing the forward look looks like. AI certainly remains a theme, but it feels like less of a driver of performance as investors really start to focus not just on the AI opportunity, but how will those AI products and initiatives ultimately change the P&L of those companies. Overall, investors continue to reward high quality, durable, and profitable growth stories in this much more volatile macroeconomic environment.
So given market conditions, so we got 2 weeks to Labor Day, give or take. So I think it feels like it's going to be quieter. I mean, you tell me if I'm wrong, but let's say 2 weeks to go. Expectations post Labor Day, rest of the year. Do you think we'll be busy? I mean, I know we've got a lot of businesses that we're staying in front of. They're monitoring their windows. I think on the private side, it feels like we're going to continue to be busy. We've got some higher quality opportunities I think we're going to bring to the market post Labor Day. I think we're largely going to sidestep the election on the private side. I think in your world, you're going to see, I mean, you tell me, but I think much more relevant. But how do you think about post Labor Day expectations around activity? And then also maybe touch on the election a bit. And if you think that might be a factor.
Yeah, absolutely. So big macroeconomic or geopolitical events definitely put pause in the public markets just because of the element of surprise or uncertainty resulting from those events. But coming back to school, we will be cautiously optimistic. Certainly, given the recent stronger US macro data that we saw last week as a result of a recession fading, it certainly feels like we will continue to see strength through the rest of the year. There are obvious broader geopolitical and election concerns that we'll continue to monitor. And I do think that that probably means issuance does slow down, or at least people start to evaluate their windows more cautiously. Namely, on the election, the outcome could bring some changes to things like trade policy, foreign policy, regulation, and fiscal and tax policy through higher tariffs and increased fiscal spending, with the risk of higher inflation as a result of this. With that said, disinflation trends and ultimately the start to the rate cutting cycle, which the market actually expects to happen in September, should definitely help drive outperformance in the US economy through the rest of the year, just by virtue of a lower cost of capital for many of the companies that are reinvesting in the economy.
That's helpful. And looking at the stats, right? So we've got equity issuance up 50% year to date, driven by a 200% increase in IPO volumes and a 100% increase in convertible volumes. Thinking about those two data points, right? Like a dramatic rebound, I think, on both products. How do you square that with respect to just all the volatility we've seen geopolitically, economically? The market and volumes continue to be, for lack of a better term, up and to the right thus far. How should we think about just the trends in the IPO volumes and the convertible volumes being up fairly strongly this year?
Yeah, so I think we definitely expected to see volumes up, especially on the back of what was a very quiet 2023. This year, we've had 45 IPOs raising $24 billion of capital, and 8 of those IPOs happen in tech specifically. The total IPO issuance, however, is still not in line with the 5-year average if you exclude COVID. And I do think that we expect 2025 to be much more in line, potentially ahead of that historical average. For the remainder of the year, we expect equity issuance largely to be driven by opportunistic follow-ons, blocks, as well as converts, which has really been the product du jour. And that's largely just because IPO volumes do tend to drop off in Q4 of an election year, specifically around the election. With that said, preparation is key, and many of our potential IPO issuers are going to start to get ready for 2025.
Yeah, totally. And I think what's also interesting is our focus on thinking through some of our mid and late stage private clients who are maybe eyeing an IPO this year, thinking about next year, and then trying to calibrate if a private capital solution, maybe one more pre-IPO round could be interesting, right? Could you diversify your shareholder base another notch, bring in a late stage mutual fund or crossover investor that could be additive to you at IPO, right? Just some things around giving the business or providing the business with another shot in the arm, some growth capital. It could buy a little bit of time to push out the IPO window if needed. And to your point, I think bridging to that visibility and building a P&L and a balance sheet that public equity investors are going to be highly receptive to. And then could that be amplified or solved, or could a company be fairly intentional with doing a pre-IPO round now to give them some breathing room or some more optionality heading into 2025 is definitely something that we're thinking more about holistically with a few of our pre-IPO clients. Well, to recap, today we dived into recent market activity in equity capital markets, discussed the performance of tech stocks, examined earnings themes, looked ahead to the rest of the year, talked a little bit about our privates business and what we're seeing there. Huge thanks to Nadine Yang for joining me.
It was great to be here, John. It almost felt like you and I were sitting desks right next to each other.
Thank you to the listeners for turning into another What's the Deal episode. We hope you enjoyed the conversation. I'm your host, John Zimmerman, and until next time, take it easy.
Thanks for listening to What's the Deal? If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. To stay ahead of the curve, sign up for JP Morgan's In Context newsletter, packed full of market views and expert insights delivered straight to you. To subscribe, just visit jpmorgan.com/in-context. This material was prepared by the investment banking group of JP Morgan Securities LLC and not the firm's research department. It is for informational purposes only and is not intended as an offer or solicitation for the purchase, sale, or tender of any financial instrument.